Hi, my name's Sam. I'm a chartered accountant and I'm on a mission to build wealth, and I want to share with you all of my tips and tricks to help you build wealth too. So I want to show you 2 easy ways to make passive income. So if you don't know what passive income is, it's basically like making money whilst you sleep. So with passive income, you don't have to do anything. The money is just building on its own. Active income, on the other hand, is when you actually have to go to do work. So you might have to go and do a 9-to-5 job to earn your money. You physically have to be there doing the job, and that is how you make your active income. But obviously there are only so many hours in the day, so there's only so many hours where you can physically make money with active income. So if you want to build wealth, you need to have passive income as well. So the first way to make passive income is using a high interest savings account, and this is super easy to do because if you leave your money in a bank account, it might attract 0.5 to 1% interest, which if you had 10 grand in your bank account might be £100 for the year. But what you can do is open a high interest savings account, which could be up to 7%, and you can move that money out of your normal bank account into a high interest savings account at 7%, and that would generate you £700 a year on £10,000 in that savings account. So I'm going to put a list of different bank accounts on screen, and I'll put the link as well in the description in the video. But these are different bank accounts that you can open with different interest rates. You need to have a look at the terms and conditions because some of the bank accounts may charge you fees which you don't want. Some of them will only let you put a certain amount in a month or per year, which is fine. You can max that out and then you can open another one. Some of them may be fixed terms, so that means that your money has to stay in there for a certain amount of time before you can access it. So I wouldn't advise putting all of your money in there if you're going to need some of it. You could open 2 accounts and put the money that you don't need in a fixed one and the money that you might need in like an easy access one with a slightly lower interest rate. The good thing about a high interest savings account is that it is risk free. You can put your money into a bank account, and as long as you haven't got over £85,000 in that bank account, that money is protected, and if anything happens to that money or that bank, then the government will refund you or reimburse you the money up to £85,000. You can also earn interest on your savings up to £1,000 as a basic rate taxpayer or £500 as a higher rate taxpayer before you have to declare any interest on a tax return. And also we have the option for the cash ISAs, so you can put up to £20,000 a year into an ISA and you don't have to declare the interest or any benefits that you've had from that on a tax return. Inflation is also currently around 3.6%, so you want to have an interest account that's paying at least 3.6% so that the value of your money isn't depreciating over time. And the next way of making passive income I think is probably the most exciting, and it's the one that I put most of my money into personally just because I know that I'm going to see a better return. So I invest in stocks and shares, and when I first started doing this, everyone was saying invest in stocks and shares, and I was like, I know nothing about stocks and shares. I know it's obviously more risky than just putting money in a savings account, and I kind of just didn't know where to start. So I'm going to give you a really easy, user-friendly way to get started in stocks and shares so that you can see good return without having to go through all the internet research and trying to work it out yourself. So what I have done personally is I have opened a Trading 212 account, and there is lots of different platforms that you can do your stocks and shares on. You can use Vanguard, you can use Trading 212, you can use Hargreaves Lansdown, but the reason that I chose Trading 212 is because it doesn't have fees. Vanguard previously had very low fees or didn't have any fees, but now they have put their fees up. So if you're only investing a small amount, it's not always that beneficial because you're then being charged on the amount that you're investing in, whereas Trading 212 currently has no fees. So once you've opened a Trading 212 account, you can either open an investing account or an investing ISA account. So if you open the investing ISA account, then the money that you make on that, you don't have to declare, it isn't taxed, that is all free. If you open a normal investing account, then the money that you make, you would have to declare as capital gains tax when you go to withdraw the money. So let's just say that you open the stocks and shares ISA. So you can put up to £20,000 in ISAs per year. So that is across all ISAs. So if you've already put 5 grand in a cash ISA, then you've only got £15,000 left to put in your stocks and shares ISA. So let's say you put 10 grand in your stocks and shares ISA. What you want to do is buy something called an index fund. So instead of buying one specific share like Tesla or Apple, and then if that company goes up and down, obviously there's a bit more risk attached to it, you buy something called an index fund, and an index fund is lots of companies together. So I buy the S&P 500, and that is stocks in the top 500 companies in the world. So it will have Apple, it will have Tesla, it will have all of the big names that you know. And then if one company has a bad period and it drops down, you've still got another 499 companies keeping it afloat. And on average, it grows around 8 to 10% per year. If you look at the graph across the time that it started to now, you'll see that it's got this upward trend and it generally always goes upward. Yes, there will be times when it comes down and then times when it goes back up throughout the year. But if you just leave your money in there and do not touch it, then it should continue to build and build and build and build. And then we get onto something called compound interest, which is where it gets really exciting. So now we're going to get into compound interest, which is where it gets really exciting, and this is where you're really going to generate your wealth and your money. So I'm going to use an example to demonstrate this. So let's say you have £500 a month that you can save into a savings account. So if you put £500 away a month, at the end of the year, you would have saved £6,000. But if you put £500 away into your S&P 500, and let's say it grew 8% that year, at the end of the year, you would have £6,540 in your account. So now you're already starting with a larger number, and then what happens is you build another 8% on top of that per year. Now let's say you save £500 per month for 10 years. So at the end of the 10 years, you would have saved £60,000. But if you had put that in the S&P 500 and you'd let it grow at 8% per year, so obviously at the end of year one, we're starting with £6,544. You then let that grow by another 8% and another 8% and another 8%. And every year the interest gets stuck on top of that starting £6,540. So by the end of 10 years, you have made £88,000. So you are already £28,000 better off by investing instead of saving. And if you look at that over an even longer period of time, so let's say 30 years, we invest £500 a month now for 30 years. At the end of 30 years, you would have saved £180,000. But if you would let that compound and compound and compound and compound again, from 10 years, where you already had the £88,000, you're building that 8% on for another 20 years. At the end of the 20 years, you would have £684,000. So you are comparing £180,000 versus £684,000. So that's a £500,000 different. And the reason that is because you have compounded and compounded that interest. You keep sticking the interest on top. The number gets bigger every year, and then you're playing with bigger numbers and adding 8%, 8%, 8%. And that's just an average for the S&P 500. So if you can afford to put in £500, £100, £200 a month into your investments, you have the possibility or the ability to earn so much money over your lifetime. So that is personally what I do. I do have some money in a high interest savings account, but most of the money that I have available that I know that I don't need, because I want to be able to leave it in there for as long as possible, hopefully until 30 years time, so I can build as much money as possible. And then at that point, I can start using that money or using it for other things. But I don't want to put money in there that I'm then going to have to take out to pay my bills, because otherwise you're not letting it compound. So money that you might need in the future, put it in a high interest savings account or an easy access savings account with a good interest rate. And then money that you can afford to put away and let it grow, put into stocks and shares, an index fund, the S&P 500, let that money grow, and that is how you are going to generate passive income and wealth over a long period of time. So I hope you found that useful. I'm going to be doing one finance or accounting video every single week to try and help give you the knowledge that I have so that we can both generate wealth. And if you did like this video, please like it and subscribe so that I can help grow my channel and get the word out there to more people.